All right, let's dive right into this explainer. We're going to untangle the wild market volatility we've been seeing lately and reveal the fundamental compass that smart money is using to navigate what experts are calling the $100 trillion AI reset. Now, if you've been watching the markets, you know it's been an absolute roller coaster. But there is a very specific, data-driven way to separate the noise from the actual, concrete growth. 50%. That's a massive number, right? We literally just saw certain AI stocks experience staggering 50% gains in a matter of 5 days. And honestly, the craziest part is that this happened right after weeks of terrifying consecutive drops that had a lot of retail investors heading straight for the exits. So you might be wondering, why are we seeing such massive, fast-paced whipsaws in the market? Well, to really understand why this happens, we have to compare two competing forces: algorithmic mean reversion and fundamental bounces. On one side, you have massive market makers like Citadel and Jane Street. When their algorithms see a stock gap up and become mathematically overbought, they run mean reversion programs to force the price back down. But on the exact opposite side, you have fundamental bounces. This is where real cash flow and actual verifiable business growth force that stock price right back up, completely regardless of what the algorithms want. Here's our roadmap for today. We'll start by breaking down the AI market volatility, then move into bouncing back with fundamental investing, cover order backlogs as our ultimate success signal, explore powering the AI build-out and solving the memory bottleneck, and finally, we'll talk about navigating controversial AI stocks. Okay, let's kick things off with Section 1, the AI market volatility. Behind the scenes, the mechanics of market making basically dictate that what goes up must come down. Stocks naturally oscillate. So if an AI stock jumps 12%, algorithmic programs will very often pull it back by a third or even two-thirds, just to cool it off. The big takeaway here is that these scary downtrends are actually just normal mechanical market corrections. They aren't the end of the AI story, and they for sure aren't a reason to panic. Which brings us right to Section 2, bouncing back with fundamental investing. I love this analogy from our source material. When the market algorithms pull everything down, fundamentally strong companies act like fresh, super bouncy tennis balls. They hit the ground and just spring right back up to new highs. Fundamentally weak companies, though, they act like heavy rocks. They hit the bottom and just stay there. So our strategy is simple. We want to fill our portfolios entirely with fresh tennis balls. So how do we find those? Let's get our compass out for Section 3. Order backlogs as the ultimate success signal. Listen, during a $100 trillion AI reset, tracking a company's order backlog is absolutely crucial. It's your ultimate signal for long-term success. An order backlog is just the total value of confirmed customer orders that a company has booked but hasn't fulfilled yet. Why is this so important? Because it represents guaranteed, locked-in future revenue. It proves with hard math that real cash is flowing into the business no matter what the stock price is doing on any random Tuesday. Now, you take those order backlogs and you combine them with a strict 8-factor fundamental model. This is how you grade any growth stock. Smart investors score companies on things like sales growth, cash flow, and, this is a big one, positive earnings revisions. When Wall Street analysts continuously underestimate a company's earnings, and those earnings just keep surprising to the upside, you get wave after wave of positive revisions. If you stick to this fundamental math, you can confidently ride out the volatility and just tune out the daily noise entirely. Let's look at this in action with Section 4, powering the AI build-out. To put things into perspective, half of all U.S. construction is currently dedicated to building data centers. Half. And you simply cannot build AI without heavy-duty power and commercial cooling. For example, Nvidia Electric provides vital water cooling components for these super hot chips. Bloom Energy is booming right now because the traditional electrical grid actually isn't strong enough for massive data centers. So they're using Bloom's natural gas fuel cells to bypass the grid entirely. And then you have Comfort Systems, who are seeing incredible backlogs just from providing commercial air conditioning for data centers being built out in the desert. And here is the wildest part. Most of these infrastructure companies are sitting on a solid 3-year order backlog. Let that sink in for a second. That is 3 full years of guaranteed revenue lined up and waiting. This means the AI construction cycle is not some flash-in-the-pan trend. It's a massive, multi-year supercycle, and cash is going to keep flowing into these infrastructure companies for years to come. Shifting gears a bit, let's look at Section 5, solving the memory bottleneck. So because AI requires a monumental, unprecedented amount of data storage, we are facing a massive memory bottleneck right now. But companies like Seagate are stepping in to solve this, and as a result, they're scoring perfectly on the fundamental model. Analysts simply can't keep up with their growth. They are routinely underestimating Seagate's earnings power. By tracking those positive earnings revisions we talked about, smart investors can ride the wave upward as these companies fulfill the explosive demand for solid-state storage. Finally, let's tackle Section 6, Navigating Controversial AI Stocks. This is the ultimate stress test for our fundamental compass. As focus learners, we really have to ask ourselves, how do we react when a company's order backlog is absolutely spectacular, but its public relations are a total nightmare? Do we trust the math, or do we get swept up in the narrative? And that brings us directly to Supermicro, or SMCI. They make some of the absolute best water-cooled rack systems for AI chips in the world, and their backlog was at one point approaching 5 years. The stock surged to $120 in early 2024. But then, controversy struck. Their auditor, Ernst & Young, actually quit, and their founder resigned amidst a legal indictment regarding shipping practices. Predictably, the stock plummeted from $120 all the way down to $25. It's basically the textbook definition of market fear and volatility. But if we step back and look strictly at the fundamental data, completely impartially, the picture is entirely different. Right now, SMCI trades at less than 10 times estimated earnings. They still represent a massive 9% of all of Nvidia's sales. And despite the terrifying headlines, they are forecasting a jaw-dropping 171% sales growth next quarter. If you rigidly follow the 8-factor model and focus on the order backlogs, the business itself is still growing at a completely incredible rate. Which leaves us with this final, absolutely crucial thought for you to take away today. When the storm of market volatility inevitably hits, and it will, how will you react? Will you panic alongside the algorithms and the scary news headlines? Or will you trust the undeniable math of order backlogs, earnings revisions, and real cash flow to find the fresh tennis balls in the market? The $100 trillion AI reset is happening. The only question is what compass you're going to use to navigate it.